I had a question from a client the other day, and they said, "So, Nancy, what is your thought about this 50-year mortgage thing?" Um, hmm. Okay, I want you to think about that in your head. 50-year mortgage. It feels borderline on like rent a furniture, like from Rent a Center, except but for like most of your life. 50 years. So, on paper, yeah, a 50-year mortgage kind of sounds like it could be a way to help first-time home buyers when, my slight concern with this is it ridiculously expensive? Equity stunting. I mean, it's sort of like a stunt loan. Um, it feels like it's designed to keep you in debt for longer, and it helps to prop up high prices. All right, let me walk you through what my thoughts are on this. My name is Nancy with Nancy Chu Homes. I am a realtor here in Northern New Jersey. And in my 19 years, I have sold over $500 million in real estate. So let me walk you through this. All right, here, let me put on my thinking eyes. In my time, I've watched buyers, make really smart, boring decisions. And I've also watched people get squeezed by choices that they actually had control over. Buying too much house, taking on like sky high taxes when I kind of really wish they hadn't, locking them into like, a brutal commute. These are some of the things I've seen happen. So when I hear about the 50-year mortgage, it's being floated as an affordability solution. My first thought is, okay, great for who? Because it looks really great for the bank, but it doesn't look that great for people. At least that's my personal opinion. So let's strip this thing down, okay, into the plain definitions. Let's look at the basic idea. It's very similar to the 30-year mortgage, except it's stretched for 50 years. So there's a 20-year growth pattern on that, right? So the pitch is lower monthly payments because you're spreading that principal over 600 payments instead of 360. Okay, so what's the reality check for that? The reality check for that is to make it worth it for lenders and investors to want to loan you money for such a long time, 50 years, to make their money back. It basically, the interest rate has to be high. It has to be higher than that of a 30-year. So extra spread, so possibly anywhere from, 0.5%, 0.75% more than what it would be if it was the 30-year. And yeah, that might, in principle, that does lower your monthly payment, which means that you can afford a little bit more because for the same monthly payment, maybe we can add another 50K, 70K to your loan. So I get that. But I'm going to be completely honest with you, given how much your equity growth slows, because when you make mortgage payments, in this case with a 50-year loan, there's 600 mortgage payments, right? And what it is at the beginning of your mortgage payment process, you're actually paying back very little equity and you're paying back more towards interest. And then over time, that sort of shifts and inverts. And at the end of your loan, you're paying mostly towards equity and less towards interest. That's just how amortization goes, right? So if you stretch that out to 50 years, you have to imagine just how little of your payment for the first few years is going to be towards equity, which means it's very hard to build equity in your home because so much of your mortgage payment is going towards the interest. All right. So I don't love that. So I had a thought, and my thought is this, which is the only reason why the 50-year mortgage sounds less terrifying, say, than a 7-year adjustable rate mortgage is because the idea of a fixed rate feels safer, right? If you have not bought a home before, or even if you have bought a home before, but you're looking to make a move, you're thinking, well, a fixed rate sounds definitely better because I can just put it on auto pay and I never have to think about it again. And it's safe. Versus when you have, let's say, a 5-year adjustable, and then for your first 5 years, you'll have a relatively low payment. And then after that, that first jump out of that 5-year mark, you can certainly see if the prime rate has gone up, then yeah, you could have a potential jump. But the truth is, most people, whether they got a 50-year mortgage or whether they got an ARM mortgage, would likely be doing a refinance within the first 5 years anyway. Because as soon as you see the rates come down, and for me, listen, I have bought like at this point in my life, like almost 24 houses, okay? So anytime I see a reduction in the interest rate by anywhere from 0.5% to 0.75%, I'm doing a refinance because it's completely worth it. Especially if you have a lender who, does low cost refinances for you because they did the original loan for you and they're willing to do the refinance for you as well, which by the way, there are a lot of lenders who ask for that. There are a lot of lenders who do it, especially if you ask for that. So I'm just saying, if you're going to be an active homeowner, given an option, I would rather take the ARM, which has a lower rate, right? Which will do the same thing in some ways as the 50-year does, except the 50-year has the higher rate, but the longer terms. With the 5-year ARM, you've got the lower rate. Actually, it's usually lower than the fixed, than the 30-year fixed as well. You have the lower rate, and you just have to pay attention for the first 5 years because it still amortizes over 30 years. It's a 30-year loan. It's just fixed for the first 5 at the lower rate. So that's what I would do, is I would go for the ARM, because then I would pay attention. I'm doing the refi within the first 5 years anyway. Because if I had the 50-year, that's what I would do. I would also wait. And then as soon as I was ready, as soon as I saw that there was, a little bit of equity built, then yeah, I'd probably do the refinance. So anyway, all in all, I'm just trying to say there's a lot of different things that are being posed out here to help with the affordability challenges that we're having in this country. And this is legit. These are legit affordability problems. But at the same time, I don't know that a lot of these solutions are all that much better. The best thing that you can do is to find yourself a home that you can work with, that you can stair step your way into that next level of home. You guys have to understand, the vast majority of people in this country used to buy what was a starter home. And then they would buy their main home. And then they might even have a step-up home. But, for a lot of folks, they didn't. And then they would have their downsized home. So it's not unusual for someone to have 3, 4 homes that they've purchased, possibly even 5 homes that they've purchased in their lifetime. So for me, the affordability question is really just about where you want to spend your money. I bought my first property based on the fact that I knew that I could grow some equity there. And then the money that property I could then sell for was going to help me to get the next one. But if you're walking out here and you're saying, well, you know what, this is so unaffordable. Where's my 4-bedroom, 2-bath house? Yeah, that we might not be able to do, but that doesn't mean we can't get you a 2-bedroom, 1-bath condo that in 5 to 6 years you can sell for 17, 18 to 50% more than you paid for it, which is what people are doing right now. And then taking that money and getting the next property. I call it the roll. You roll from one property to another. And so, yeah, it's sure affordability, but it's also what is it that you think you can afford, and alter your perception of what it is that you think you need to get started. It's better in the end than renting. Because I've heard people say, well, I'd still rather rent because, I'd rather rent this 3-bedroom house. It fits my family better, except for the fact that you never get on top of it. Versus if you spent 2 or 3 years, owning a slightly smaller property that you kind of make do with until you can sell it and get the equity out to roll to the next property. Because basically when you do the renting part, there is no winning. Like, you can never save enough. People say this all the time. They're just like, if I just save a little bit more, I'm like, I don't know how you can outsave a market where we're seeing 6% growth year over year. And depending on the town, we have towns out here in northern New Jersey where, there's been growth 11% year over year for the past few years. You can't outsave that. You can't out-earn that. You have to find another way to do this. And I'm telling you now, get the smaller property and roll that. All right, guys, thank you so much for listening to me. Please, 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 if you are considering a 50-year mortgage, I'm not kidding. I don't care where you live in the country. Give me a call. I will talk you through why I'm concerned about this. 917-992-3098. Yep, that's my cell phone. You can call me. I will, or shoot me a text first so that I know, and then I'll pick up. But yes, if you are considering that because you think that it's your affordability solution, give me a call. I'll walk you through what other options there are, okay? All right, guys. See you next week. Thanks for listening. Oh, and by the way, if you like what we have to say, please comment, like, and subscribe so we can help other people. We're trying to grow our audience because hopefully we have good stuff to say, and we're hoping that you guys like it. All right, talk to you soon. Bye.